Hi, everybody, and welcome to EBNet Stream. I once again have the privilege of interviewing Kelebogile Moloko, who is the founder and chief investment officer at Prowess Investment Managers. Welcome again, Kelebogile.
Thank you so much, Natalie, for having me. I look forward to the chat.
Excellent. So, in my mind, just for our listeners and our readers, the compulsory preservation of members' retirement pots lends itself to longer term investments and possibly might be positive for infrastructure investing. So I thought I would investigate this with Kelebogile to see if I'm on the right track. So let's start. In our last conversation, Kelebogile, we talked about impact investing. As I understand it, investing in infrastructure is a way of making an impact. Am I understanding it correctly?
No, definitely, Natalie. You know, as I said the last time, that infrastructure investing is part of the private market strategy alongside private equity and real assets. And if we go to what defines an impact strategy, if we recall, you're not only looking at financial returns, but you're also incorporating positive and measurable social and environmental impact, right, in the investment strategy. So that is the bedrock of infrastructure, because an infrastructure actually does incorporate social and economic aspects which are positive that underpins an economy. But I think also important is that ESG factors, which is environmental, social, and governance, are also quite key to infrastructure investing. So when you do your assessment, you are forced to actually incorporate ESG factors, which is also another element or pillar for impact investing. So a lot of infrastructure assets have got a very large environmental footprint. And most of them, if not all, have got a direct social impact on stakeholders and also the region within which the project operates. And then you might think, okay, governance, how is that relevant? So governance is also quite key. You would find that most of the project might be complex in terms of the structure of the project, but in many instances you might find that assets depend on concessions or legal agreements or contract from government-related parties. So in that scenario, then governance is actually highlighted as well. So your understanding is spot on that it is actually one of the key pillars in impact investing.
Lovely. So then maybe we can go into a little bit more detail. What exactly is infrastructure investing?
Infrastructure investing, can be defined as the provision of essential facilities and services within which economic productivity of a society depends on. I know that's a mouthful, but it's very important. And when I make examples, it will also make sense. So when you look at the investment or the assets that you invest in, they're typically involved in the movement of goods, the movement of people, provision of water and energy. And I'm just going to use a couple of examples and categories in terms of giving us a sense of what infrastructure is. So first, you have what we call regulated infrastructure assets or investments. So the typical example will be Eskom, that actually provides electricity to our economy. You could be looking at a gas or oil pipelines. You would be looking at a water distribution system. I think in South Africa, we've got water boards, right? Or even municipalities that are responsible for water distribution or waste collection. So that's a very core part of infrastructure. Then you move to transport infrastructure investment opportunities. So there you're thinking about toll roads. I know a lot of people, especially the Gauteng people, were up in arms about paying, toll fees a couple of years ago. You're looking at bridges, you're looking at tunnels, you're looking at airports, you're looking at seaports. So that will be more your infrastructure, the transport part of infrastructure investing. Then you have communication assets or investment opportunities. So there you'd be looking at radio and television broadcasting towers. You're looking at communication towers, cable systems. You're looking at satellite networks. And you might think, okay, fine, where does that feature in South Africa? Obviously, think about MTN, Vodacom, Cell C as an example. I mean, that's very, even Telkom, right? Those are the companies that will fall within that cluster. And least but not last is social infrastructure, which is now you're investing in schools, in hospitals, in prisons, or in courthouses. But there are some of the subsectors that have gone mainstream, which we should be familiar with, which is digital infrastructure, which is now telecommunications towers, data centers, which have become very important, especially from a risk management perspective. You've got fiber optic networks. If you don't have fiber, you're not fashionable anymore in your house, right? And then
I'd have
we
to ask my
have
children.
yeah. Then you have energy transmission infrastructure investment opportunities, and in a case, it's like renewable energy, right? Has become like quite big. Going green has become quite big. The issues of ESCOM, and then you also have energy storage or inefficiency. And then you have other sectors such as logistic assets, which is food supply chains and cold storage, healthcare and education businesses that have sprung up as well, where it's not just the basic social infrastructure provision, but it's more added benefits and other infrastructure services. So it's quite wide, but it's also very important from an investment strategy then to determine, do you want a diversified infrastructure focus investment thesis or portfolio, or do you want to go sector specific as well, right?
So, I mean, it's obvious that any trustee or any member of a fund would want to invest in building the country,
Yeah.
or in building the infrastructure of a country, like you say, schools, healthcare, hospitals, bridges. But what is the business case for a retirement fund trustee to consider infrastructure investing for a fund?
Yeah. I think that's a very important question, because then, we can talk about wanting to put money to do good and to close out whatever gaps, but it also has to make sense for the capital providers that it actually meets the requirements or objectives. So infrastructure is quite unique in that it's able, as an asset class or as an investment strategy, it's able to provide steady, reliable returns across a wide variety of economic conditions. So when I mean by a wide variety of economic conditions, and I'll make an example, like if you look at infrastructure returns from around 2004 to 2021, the only two periods that returns were negative was during the 2008 crisis and a blip during COVID. But throughout that whole period, you had very decent returns that were very stable and outpacing other asset classes. So returns are usually inclusive of a cash yield, which is beneficial for investors that are looking for income, but also some total return, right? So there are other attributes which are quite key in terms of why would you invest in infrastructure. I think the first one is the intrinsic value, which we've already spoken about, that infrastructure is providing basic services which are required. There are large sums of capital that go into the project to develop it, operate it, maintain it. And usually they are monopolistic in nature, meaning that there's very less competition. So there is actually intrinsic value, meaning that you are going to get some returns if the projects are actually well managed and well run. So that's a very good thing for an investor to hear, right? Because you want a return on investment. They have very unique return drivers. So as I alluded to, so the revenue stream or the financial performance is actually undergirded by the contractual relationships that are embedded in the project. So either there's a regulatory framework of a particular project being commissioned, or there's a concession agreement similar to toll roads, which are backed up by the Ministry of Transport, or there's long-term contracts, or the project is linked to something that is essential in terms of just GDP economics. So just from that context, that then covers a lot of your financial risk in terms of your investment strategy. Then we've also seen that they are very low correlated to other asset classes. And it's because of the two attributes that I've actually mentioned. So it doesn't matter which period, you would find that they are uncorrelated to public debt returns or public equity returns. But even within the private market strategy, you'd find that there's very low correlation to private equity and also to real assets. So they are unique in that context, that if you're looking for portfolio diversification, you're looking for the steady printing of returns, then, there's no argument in terms of going into infrastructure. And they have very low volatility, as I've alluded to. I've already touched on that. And then they also are an inflation hedge by nature, because then the revenue is then linked to inflation adjustments. So, toll roads, I know a lot of us complain, it's like toll tariffs are going higher. So every year there's an inflation adjustment, right? So you'd find that most of these projects, the contractual arrangement is that there will be that inflation pass through. So meaning that it's actually you getting real returns as an investor. And because of all the other attributes that I've actually mentioned, when you look at the return profile, you're actually getting absolute returns rather than, volatility in returns. So the combination of all of these benefits is what is actually appealing. But not only that, you're rebuilding a country, or you're, addressing a gap in terms of a particular essential, service that is necessary for the economy.
So not only, like you say, are you building the country, but there's also wonderful diversification benefits in infrastructure investing. Some of
Exactly.
those I hadn't even thought about. But a lot of what you are describing seems like quite long-term projects, or kind of fixed equipment or fixed buildings.
Yeah.
In a retirement fund environment, we aren't able to sell half a bridge to be able to pay a big retirement claim. So where does liquidity fit in terms of risks of these type of investments?
Yeah, I think it's quite important to take a step back for trustees or decision makers when looking at infrastructure, to say that, the decision to participate should be very much structured alongside a clearly defined investment strategy and a risk profile that's aligned to what the fund wants to achieve, right? So that's very, very important, especially for smaller funds, because, inherently the nature of most infrastructure projects is that they would be unlisted. There will be long in terms of maturity or tenure. So, toll roads, they can go for 20 to 30 years. That's a long time. And there's usually no secondary market, in terms of, okay, we can just sell the asset to liquidate to be able to give you, the proceeds that you need as a retirement fund. So when looking at the strategy, it's very important to say, okay, fine, how do I balance the need to be in infrastructure and the liquidity requirements of a fund, right? Because inherently liquidity risk is embedded in infrastructure investing. So a fund also needs to obviously be guided by Regulation 28, because Regulation 28 says 15% of your total assets can be in unlisted assets. So within that context, not many funds have deployed that 15%. I think most of them are even below the 5%. So let's assume we get into a scenario where all funds are going to the 15%. I think it's very important then to balance that out with the listed component or more liquid assets within your portfolio allocation, so that you can actually mitigate the liquidity risk. For infrastructure assets, the base is that you invest until the asset matures, right? It's very important. There might be secondary opportunities, but as I said, they're also very, very, very limited.
So look, retirement funds are long-term investments, and this compulsory preservation now in place with this retirement pot definitely speaks to this long-term nature. So I think more and more trustees are open to investing more than currently. But how would they access infrastructure investments?
Yeah. So there are various ways that you can access infrastructure investments, but it also speaks to mitigating the liquidity risks that I just spoke about, right? So funds can go into an open-ended fund, or they can go into a closed-ended fund, or they can actually look at a fund-of-fund options. So in all instances, I think it's very important for funds to make sure that when they are allocating to infrastructure that is within a well-diversified allocation framework for their fund. But also that they find quality managers to manage the assets, because then they're not vanilla assets. They require expertise that are slightly different from your public market investment strategies. So let's look at an open-ended fund. So usually you'd find that there are portfolios that exist that might be pooled vehicles on a balance sheet, right? You get issued with a policy and you're within a pooled structure. And it's open-ended in the sense that the investment manager, the asset manager, can actually invest in an asset until it actually matures. But the structure allows for buying and selling of units by different pension funds. So you would find at any time, because then there's daily valuation on the portfolio. So that actually helps funds that are looking for liquidity, or even some of the small funds that can't actually deploy the strategy on their own, but they need to, to be crowded into an existing platform. Then you have the fund of funds model, which is, a fund of fund would obviously then look at different asset managers that have got funds that invest in infrastructure, and then they would then invest in a diversified portfolio of fund managers. So there, the benefits obviously are that you might be able to access different infrastructure strategies instead of just maybe one portfolio. You might be able to access different vintage years in terms of when the fund was started, and different return profiles instead of just being, forced to one vintage. But at the fund of fund level, if there is some liquidity, because it allows for funds to come in and to go out as well. So there you might also find a little bit of liquidity, even though it would be more limited than an open fund, right? And then you have what we call closed-ended funds. So typically for private markets, this will be like a limited partnership, right? So there, the liquidity is close. I mean, it's very low. Let's admit, because and even though you might have a couple of investors coming in as limited partners within a limited partnership structure, it's a closed-end fund, and there's a portion that you actually buy, or a share of the portfolio that you actually buy, and so forth. So there, then you have to kind of like be well informed to know that you are married until until the children kind of like go to university, or they're married, right? And they're out of the house. If I can use that analogy. So some of the large funds will go segregated, where, obviously the likes of your GPF or other large funds, they might just kind of like choose a strategy. We want to be in renewables. We're going to commit 1 billion, and it's going to be in our name. And we know that it's a small component of the entire portfolio. And we don't mind actually, wearing the liquidity risk premium, because it fits our profile. So those are the different implementation strategies that funds have as options.
What other risks or am I not thinking about here? Because I mean, so far you've managed to deal with the one that I've pointed out being liquidity, but you managed to paint a picture of something that's very compelling as an asset or as an investment for a retirement fund. So what other risks, would you caution trustees to be thinking about?
Yeah, I think it's very important. I mean, other than the liquidity risk, I think the choosing the right manager that has got the track record, which they have demonstrated that they can actually manage such assets, it's very, very, very important. And not only in terms of choosing the right infrastructure assets to incorporate in a portfolio, but they can also deal with difficult projects that don't go according to plan, right? And they can do workouts. So the fund needs to satisfy themselves just in terms of the right partner in terms of deploying capital and giving you the returns. But from an investment strategy perspective, it's very important to understand that there's operating or technical risk for each, either at a project level or even at a fund level. So by that, I mean, so if we think about a technical risk, I mean, the renewable assets, it takes some level of technical expertise for those assets to be actually developed, to be operated, and to be maintained. So do the companies that have been given concessions have the requisite skills to actually build such a project. I mean, I'll make an example of potholes in South Africa, right? Where contracts are given. I think, sorry for those people that are from Mpumalanga. When I drove there, I was just surprised just in terms of the quality of the roads, and people complain to say that the contractors don't have the technical skills to actually, restore potholes. So they would be given money, do something, and within a couple of weeks, or if it rains, then we back to square one. So technical skills are quite important. Then, so that's technical risk. Have you mitigated the technical risk? The second thing is operating risk. So the management or the team that is operating the asset, do they have the right skills to operate the project? And we've heard of, and I'm not going to say it's valid, because when you read the newspapers and there's stories going around about some of the ESCOM, plans and so forth, that you don't have the right skills in terms of operating the project, or it might be another project, or whatever the case might be. So that becomes important, because as much as you might have the revenue aspect ticked off through your concession or agreement with a government or some multinational, how the project actually performs from a technical and operational perspective is very important, because that's where you can lose money if that is actually not in place. Then the legal compliance, regulatory risk, and political risk is another one. From a sense that most of these assets, especially if there are more regulated assets, they're underpinned by some regulatory framework. There is some legal compliance that is actually required, and some of them, before licenses are given, you have to meet certain criteria or requirements and so forth. So it's very important to ensure that at any point in time, either the underlying assets or even the portfolio is actually very proactive in terms of identifying these risks, mitigating them, and being ahead of the curve in terms of potential changes. Because sometimes you find that the regime changes, and then the legal framework also changes, or the regulatory framework also changes, where you've already put billions of rands into a project or portfolio. So you want to make sure that you are connected to the key stakeholders in terms of potential changes, and then you are part and parcel of engagement in terms of ensuring that you have the right voice and seat at the table. Environmental risk I've already alluded to, because it's quite important in mitigating that. And then other two, which are quite important from a fund perspective, is what we call vintage year risk. So, which is what I was talking about, that, depending on, especially when you go more into private equity or equity infrastructure assets as well, the year in which you invest, the underlying economic conditions obviously impact the outcomes as well, right? So it's very important that you kind of take into account the vintage of the fund, and that's why some of the consultants would more prefer fund of fund implementation strategy, because then there you have multiple managers with different vintage years in terms of the strategy. And then the last one is a blind pool risk, which refers to you give prowess 100 billion, and you say you want an infrastructure strategy in renewables, and we invest. We consult you. We think we understand what you need as a client and what your impact investing strategy is, or even the sector focus, but only to find out that after we've invested, it's a little bit divergent from what the fund actually had in mind. So it's very important to have that partnership alignment, even though the manager has got the discretion to deploy that, the fund or the retirement fund is very much involved to ensure that, we are dialed in terms of aligning to the objectives of the strategy, and then the sector, and then the impact aspects. So those are the ones that I'll mention now. I mean, there are other risks, but I think for me, those would be the core key ones that are quite important to consider.
I think you've set out a wonderful list of things for trustees to not be aware of, but rather to ask their managers. and to engage with their managers and to really make sure, like you say, that everybody's kind of singing from the same hymn sheet,
Yes.
so that expectations don't lead to disappointments in the long term. And speaking of disappointments and expectations, just you spoke about returns earlier, so just a quick response on the kind of returns that trustees and members could expect from their infrastructure investments.
Yeah, I think, I've already spoken about the returns are stable, they are steady, the inflation beating and so forth. So it also depends on which strategy you are invested in, right? So if it's infrastructure debt, the profile should mirror, returns that actually speak to that particular strategy. So when you compare those returns, you also have to compare them to the listed markets, in terms of debt. Are you beating inflation? Are you doing better than the listed market? Obviously, in seasons of high inflation, then you would find that the returns are going to outperform the listed market. But where inflation is low or whatever there's demand, then you find that listed markets will actually outperform, infrastructure debt. So it's very important to take that into account, but also to go back to why infrastructure, because you want the stability of returns. So there will be times when public markets might outperform in seasons, but it's fine because you're still getting the stability of returns, whereas in public markets, you have the volatility, right?
Volatility.
So that becomes important in terms of how do you then judge the returns that you're getting versus other asset classes. But having said that, there has been work that has been done by various people in different periods where you would find that for listed infrastructure assets, they've actually outperformed. I think I was looking at a chart from 2008 to 2021, where the cumulative returns have actually outperformed the S&P, for example, by a huge margin, right? Yeah, so the return prospects are quite strong, but then what you compare it to and the purpose for which you have it in the portfolio should also be part of your assessment in terms of the returns. Yeah.
And understood by trustees and members,
Exactly.
to get a full feel and a full appreciation for the context.
Yes.
I'm going to end off with potentially a controversial question, but let's go there. Infrastructure investing is really investing in a country and investing in the buildings and the assets of a country. And one of the topics that kind of raises its head every now and then is that of prescribed assets. How do prescribed assets and infrastructure investing, do they live together? Do they not live together? What are your views on those?
Yeah, that's a very interesting question. I think most of us actually avoid that question or even answering it. But, I'm going to go from a neutral perspective to say, if you look at Regulation 28, I think within the framework, there are principles embedded which then would support unlisted investments or assets, which also includes infrastructure, right? So when you look at infrastructure, you can do it within the 15% of your unlisted allocation. But you also have infrastructure that's listed. Most of the state-owned enterprises where they issue debt on the listed debt market, you can access that within your debt, allocation as well. I think we need to ask ourselves why some stakeholders maybe might want to go the prescribed route. I think, yeah, it's more of a frustration because even though we have these limits that are embedded in Regulation 28, which should encourage retirement funds and asset allocators to channel capital towards infrastructure or private markets. The actual percentage of capital allocated there is still very low. It's below 5%. So then, okay, fine, we've got a regulatory framework, we've got the principles of how it works, we've got funds that demonstrate that it actually works, then what's going on? So maybe we should actually bring a bit of shambok, right? And say we're going the prescriptive route for us to actually line up and get maybe to 15%. So while I have an appreciation for why people might be talking about prescription, there are pros and cons in terms of prescription. And the negative aspects of prescription is that you have a capital flooding into assets that might not be well structured or well managed. The returns are also very low. So there are unintended negative consequences in terms of value that is created or that is actually derived by pension funds. So I would say that we need to come and collaborate as an industry in terms of different stakeholders and say, why are we below 5%? Whereas, we've got a beautiful mansion. We can live anywhere, but we've decided to live in one part of the mansion and we're not occupying the entire building. So let's have those conversations and then move towards actually increasing capital, focusing on infrastructure and private markets before we go to prescription.
Thank you for at least taking the question and not avoiding it like some of your counter parties in the industry. Kelebogile, as always, it's a pleasure having you. Thank you for sharing your views and for educating us more on infrastructure investing. Thanks very much for sharing your time with us.
No, thank you so much. This was enjoyable. Appreciate the opportunity.
You're welcome. Keep well.
Thank you.